In today's video, I want to touch on a semiconductor company, a semiconductor stock that you probably never heard about before. To be honest, a week or so ago, I didn't even know this company existed. Now, this company has seen its stock go down by 85% year to date, but analysts expect the stock to go up by 100+% in the next 12 months. Not too bad, right? Okay. So what does this company do? Well, this company is called Wolfspeed. Wolfspeed was previously known as Cree, and Cree, they were in the lead business. Now, silicon carbide, not silicon that we're used to. No, better apparently, silicon carbide. So what do they do? Why is it better, etc., etc.? Let's go over all of that in this video. Oh, by the way, the CEO did get replaced finally in the last couple of weeks. So there is, I guess, some better news for most investors that have been with the stock for a long period of time. So let's discuss all of that. Hit all the buttons, like, subscribe, notification bell on. Would really appreciate that. We're very, very close to reaching 60,000 subscribers. So thank you very much for all the support. And if you want to support me even further, do check out the link down in the description and in the pinned comment. Could be top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. So Wolfspeed. What do they do right now and why is it better than the rest? So they specialize in silicon carbide technology. They produce a range of products including silicon carbide materials, power modules, discrete power devices, and power die products. These components are used in various applications such as electric vehicles, renewable energy, data centers, industrial applications as well. Why? Why go with silicon carbide and not just regular silicon? Well, one, it has a higher power density, lower power loss. So silicon carbide devices generate less heat, leading to improved efficiency and reduced cooling requirement, which of course is great for data centers and is also great for electric vehicles. They also have faster switching speeds and wider operating temperature range. So imagine if your electric car has it, or imagine if your data center has it. I mean, more energy efficient, you can maybe drive for longer periods of times, and charging also happens much faster. Now, I know that Tesla did ditch a large part of the silicon carbide plans that they had, but there are still plenty of other companies out there that are using it right now or are supposed to use it in their next generation of vehicle. So just so we're clear. And so looking at Wolfspeed right now, as you can see, it's a company that is worth less than $1 billion. Its stock is down 85% year to date, down 52.3% in the last 3 months. Actually, before the market opens, this stock is up 6.6%. So, okay, apologies for not making this video a bit earlier, but still, I don't think this will make such a difference if this company is successful in turning everything around. Now, if we look at one pricing metric, which is EV to sales, 6.6 times. Previously, it was a bit higher. Well, much higher actually. Back in February 2021, everything was much higher. It was trading at above 24 times. Now, you can clearly see here that for fiscal year 2025, they're already in fiscal year 2025, sales growth will be very, very minimal. Just 1.18%, no profitability in sight. Then, fiscal 2026, sales growth of 43.7%, and then another 43.3% in fiscal year 2027, reaching break even, but still quite some ways to go. Looking at the average analyst price target, 17 analysts covering this company sits 116.5% higher than the price we're at today. And so if we zoom out a little bit, we've seen what's expected for revenue growth, but just to show what has happened before, right? Growth hasn't been there for a while. For these types of companies that, well, say themselves that this is the next best thing, etc., etc., especially since we are moving towards renewable energies, EV growth, data centers, most investors probably would have expected huge growth here. Okay, we might expect to see in fiscal 26 and 27 those types of growth rates. But as of now, that's not the case, and free cash flow should be close to break even by the end of fiscal 2027. Looking at some other metrics, and here you can clearly see, gross profit margins have basically plummeted in the last couple of quarters. There are reasons for that as well, which we will discuss right now. First up, they announced not so long ago that the CEO, Greg Lowe, will depart this month from his role as Wolfspeed president and CEO and as a member of the board. The board is conducting a search to identify a permanent CEO with the support of a leading global executive search firm. The board has appointed Thomas Werner, chairman of the board, as executive chairman, while the board works to identify Wolfspeed's next CEO. So, yeah, I mean, I've seen some comments from a lot of folks and they were quite happy with this change, probably because, well, the stock has not been performing quite well under Greg Lowe. Now, switching to the latest earnings report, and this was still with the previous CEO, so we've got a lot of things going on here. This quarter, we took action to solidify the capital structure, simplifying our business to accelerate structural profitability and support the build-out of our state-of-the-art silicon carbide facility. We will have a 200mm silicon carbide footprint at Mohawk Valley and North Carolina materials factories that we target to generate approximately $3 billion in revenue annually. Last month, we reached a significant milestone by signing a non-binding preliminary memorandum of terms for up to $750 million in proposed direct funding under the CHIPS and Science Act, and in addition, $750 million from our lending group, demonstrating substantial progress towards our funding goals. With this announcement, we now have access to up to $2.5 billion of incremental funding to support our US capacity expansion plans. Of course, when you expand, when you build out factories, margins do get hit because you're spending money on things that are yet to generate anything for you, a bit like what Intel has been experiencing. They continue here to drive operational improvement. We are taking action to enhance efficiency, align our business with current market conditions, and become the first silicon carbide company to transition to pure play 200mm. In parallel, we remain focused on optimizing our capital structure, further reducing our fiscal 2025 capex guidance by $100 million to align the pace of our spend with the broader shift in EV market demand. Of course, with Trump coming in and maybe removing the IRA tax credit, maybe EV growth will slow down even more, and that's definitely not great for a company like this. Now, currently, they said that they delivered 2.5 times year-over-year growth in their automotive business in the first quarter, and they expect their EV revenue to continue to grow throughout calendar 2025, as the total number of car models using a Wolfspeed silicon carbide solution in the powertrain increased by 4x from 2023 to 2024, and is expected to grow by another approximately 75% year-over-year in 2025. I mean, if they can continue to prove to other automakers that, look, this is the results by using our products, you should switch as well in your future models, then yeah, we could see these types of growth continue. Now, with regards to the restructuring and facility closure. So during the first quarter of fiscal 2025, Wolfspeed initiated a facility closure and consolidation plan to optimize its cost structure and accelerate its transition from 150mm to 200mm silicon carbide devices. Wolfspeed incurred $87.1 million of restructuring related costs in the first quarter of fiscal 2025, of which $34.3 million were recognized in cost of revenue, net of $52.8 million were expensed as operating expense in the statement of operations. For the second quarter, the company expects to incur $174 million of restructuring related costs, of which $34 million will be recognized in cost of revenue net, and the remaining $140 million will be recognized as operating expense. Now, with regards to the startup and underutilization cost, Wolfspeed is incurring significant factory startup costs relating to facilities the company is constructing or expanding that have not yet started revenue generating production. And so now you start to understand why margins have come down, why sentiment is not that great. On the flip side, they did record $1.3 billion of design wins in fiscal year 25 Q1, the third highest on record. They also secured $1.5 billion of design-ins in fiscal year 25 Q1, with approximately 70% for EV platforms. They say here $11 billion of design wins and targeted cash savings activities significantly lower break-even point and accelerate path to generate positive cash flow from operations. Well, if you look at guidance, we see the following. For the next quarter, revenue between 160 and $200 million, which is lower than right now at the midpoint. Non-GAAP gross margin, negative 6% to positive 6%. Non-GAAP OPEX, $105 to $115 million, so $110 at the midpoint. They give us here the long-term profitability target, so non-GAAP EBITDA profitability in the second half of fiscal 2025 and operating cash flow break even in fiscal 2026. And so now with all of that out of the way, right? All the restructuring costs, startup costs, new CEO, we're still waiting for the new CEO. They basically threw the kitchen sink at it, right? They threw everything at it and now let's see what happens. Because it really is a let's see what happens type of story. Because if it is truly such a good thing, then revenue should naturally reaccelerate. The company should be growing much quicker than it currently is, right? And that's basically the conclusion I'm reaching. It's, okay, you've shown me everything that you are trying to do. You've shown me everything that you are doing right now. Funding, etc., restructuring, we know build outs of factories. They cost a lot of money. And then until you actually make money, it takes some time. We know all of that. But now it's time to execute. If silicon carbide is so much better than the rest, why aren't you convincing more clients to switch, right? Of course, now without a CEO, you have to wait. Fine. But that's the thing. We will have to wait. As investors, you don't like uncertainty. And of course, we're always forward looking. So everything that happened in the past happened in the past. Okay, we have to know about those things. But we are forward looking because we want the gains to come in the future as well. So now we wait. Currently, we are in a place where this stock has been back here. Well, we had to zoom out quite a lot. But then again, different companies. So really no point of actually looking that far behind. But yeah, right now we are under $7 here on the graph. Apologies for all the movements here. But yeah, on the weekly, we're not even oversold just yet. So I would say right now, sitting on the sidelines is not the worst thing to do. Yes, maybe you might initially miss a short-term bounce from whatever is going to happen. New CEO gets announced, a popular name, etc. Okay, fine. But it's better, no, to wait and see, oh, okay, we're moving in the right direction. The new CEO makes sense. Okay, I'm willing to give up on the first 10, 20% or so, and then put my money in because I know that if this is successful, it will be worth more than just $800 million in market cap as a company. Then on the flip side, maybe in the future it might get acquired if silicon carbide, if you need that technology, that supply chain, if it is really successful, yeah, maybe it might get acquired in the future, especially if it stays under those levels, right? If it stays under $1 billion, even under $2-3 billion or so. So yeah, remains to be seen. Interesting story to follow. If you know more about this company, let me know down in the comment section below. Like, subscribe, do all of that, and I'll see you all in the next one. Bye-bye.